the Indian stock markets have experienced a notable downturn in the last 5 months. The Nifty 50 alone saw roughly a 15.8% decline, falling from 26,277 to approximately 22,124 as of yesterday. Sensex corrected to 14.9%, closing at 73,198. And this brings a lot of questions to retail investors, whether this is the right time to invest in equity mutual funds. Should investors continue with the monthly SIPs, or should they stop their monthly payments until there is a trend reversal on Dalal Street? To answer all those questions, joining us on the show is Feroz Aziz, Deputy CEO, Anand Rathi. Feroz, always a pleasure speaking to you. Thank you very much for taking time out. I think I'm going to begin with the most basic question first, and that is, what should investors do right now? They're jittery, markets are not giving them similar returns vis-a-vis last year this time around. What should they do? Should they stay invested in equity mutual funds, or should they wait for some green shoots?
Good morning, Shweta. Like you rightly said, this is one of the most popular but yet a basic question. If I were to be asked this question which you have, I would tell the investor that reflect upon what you had thought when things were good. When you invested, of course, you thought long-term, point one. Now, where's the long-term? The long-term is nothing but going through the process of the short-term painful process to reach the long-term. The second is when you investing in a systematic investment plan, for example, you're investing at different points in time. And we've always heard that volatility is a friend of a systematic investment plan over the long run. And in fact, if you look at history from 1993, when mutual fund industry was privatized, and if one were to actually do a 10-year SIP, if the first 5 years have been bad, the subsequent 5 have made up and more for the first 5 years. So much so that if the first 3 years are very good, you don't have to be too excited, because the 10-year return is going to be 12-13%. If the first 3 years have been bad, the total 10-year return has been 20-21%, even in a flexi cap fund. So point one I'm trying to make is stay invested, remind yourself of what you were thinking when you started your investment. Second, like Navneet Monad, I was hearing him somewhere, and he says that bad news and good prices don't come at the same time.
Okay.
So continue investing and invest more if you have the money at the sidelines.
All right. And now that, viewers know that they should continue investing, I think one of the questions that weigh in on everybody's mind is it time to rejig their portfolio? And if yes, what should they invest in more? Because one of the favorites of people that has emerged by the way of an asset class is gold. Looking at gold ETFs, which have been on the rise, as you can see on our screens, from December of 24 to December of 25, from about 640 crore rupees to about 3,751 crore rupees. Is gold the way forward? How should people rejig their portfolios?
Shweta, yes. Yes, should they rejig their portfolio? At least 60-70% of India needs to rejig their portfolio. Okay. Indian households need a rejig on two counts. One, because we've operated in extremes. Some people are completely in debt. Some people have gone the other extreme, having 70% in equity, 80% in equity, that too small cap. So I personally think the answer somewhere lies in the mid ground. So point one, now if you have, from a risk standpoint, if you have more than 60-50% in small cap, even after the carnage, you will have to mend your portfolio and come on the equity portion to not more than 20-25% in small cap. That's one. Second, India's asset allocation is not correct in our opinion. Why is it not correct? Because we have 92% of your last year's saving going into debt and debt-like instruments. Equity has only formed 7-8% of the last year's 35 lakh household savings. If the market is corrected, India has not invested in equity adequately, is why I would say your asset allocation needs to move to at least 50% in equity at this time and use that as an opportunity post-COVID, which has hard come.
All right, invest in equity, that's the word coming in. But, looking at some of the data that has come by the way of AMFI as far as, changing preferences is concerned, large caps is seeing some sort of, tapered interest from December last year to January of this year. You're looking at mid-cap, large cap, small cap funds there, and the interest that continues to sustain in the flexi cap funds. As far as what should investors choose going forward, should they stay invested in large caps, or should, and the conversations around froth in small caps that continue to make headlines, till date. Is that something that they should be cautious of? Stay invested in companies with strong fundamentals?
Shweta, yes, there were a couple of very important questions in your question. So first of it, I would say let's go to the large cap debate. I think Indian investors have done a very sharp job this time around. If you look at their investing, even in the February number, we have an algorithm which tracks what is the daily inflow in small cap funds. I wouldn't be surprised when the numbers come in about 4 or 5 days. You will still see about 2,700 crores invested in small cap funds, which implies that the retail investors still ready to buy a dip. Otherwise, retail investors, unfortunately, always used to buy the frenzy and sell the dip. That's changed, point one. Point two, I think large cap should be 60% of your portfolio. Why should it be 60% of your portfolio? Because 27% of Nifty is banks, and banks are trading at their all-time low valuations, if PE is any measure. So I would say large cap definitely 60% of one's portfolio, and that's what our model portfolio currently reflects.
All right. And I know you don't give stock specific guidance, but I think, traditional investing wisdom will tell you invest in stocks. If you can buy on dips, why not? Especially with companies that have very strong fundamentals. And we've seen some of these companies, lose substantial part of their valuation, stock valuation. Primarily conversations around Tata Motors, Reliance. Should you buy some of these stocks? And if yes, what would your picks be?
See, I would just try and throw a color on the strategy. If you look at the NSE 500 stocks from 1st of January, there are some stocks which are in the positive, some substantive portions of them are in the negative. I would look at a strategy which tests the ownership pattern. See, fundamentals are there, but unfortunately, investors don't close their apps for 10 years and open 10 years later. They want to see it every day, and every 3 days of fall creates a havoc. So I personally think if you want to look at fundamentals, you have to also look at it with how strong is the ownership. If you look at NSE Small Cap 250, which is the largest debate over the last couple of months, you see about 11 stocks till yesterday are in the positive territory from 1st of Jan, and there are about 239 stocks which are negative. So these 11 stocks which are positive implies that the owners who own these stocks are such strong long-term owners that you will not see very large risks when you own them. That's why they throw up a lower beta. So always look at stocks which have one of the most stable ownership rather than the most fluid ownerships. There are stocks which have fallen 52%. One of the stock in NSE Small Cap 250 has fallen 250. The bottom 30, 40 stocks don't get lured that they are cheap now. It will take its own sweet time for the confidence of the shareholder to be built to be held for the long term. So as a strategy, don't just be lured at the price. Also look at what kind of solid ownership some businesses have, that even if there's a crash in the market, the seatbelt actually works and the airbag opens. That's what I think is the biggest barometer of value at risk when you're creating a direct equity portfolio, if not a mutual fund portfolio.